Delaware Statutory Trusts, or DSTs, can offer great options for investors performing a 1031 exchange. DSTs are passive investment vehicles, which can provide investors with quality institutional-grade real estate and can potentially be a great tool to defer capital gains taxes. For real estate investors, this is an attractive proposition. DSTs came to the forefront in 2004 when the IRS issued a revenue ruling on how DSTs can be structured to comply with tax laws for 1031 exchange purposes and be used as a vehicle for investors doing a 1031 exchange. The IRS listed 7 requirements, also known as the 7 deadly sins for DSTs. The 7 deadly sins of DSTs are as follows. 1. DST by either existing or new investors. Based on the value of your initial investment in a DST, you will receive a pro rata share of ownership. Future investments may weaken ownership percentages and shares, impacting an investor's claim to the DST assets, so they are disallowed once the offering is closed. 2. The trustee of a DST can't borrow additional funds or renegotiate the terms of existing loans. Prior to accepting investments, the sponsor of a DST must disclose the loan amounts associated with the property. 3. A DST cannot reinvest proceeds from the sale of its real estate. Instead, proceeds must be distributed to the DST's various beneficiaries. DST investors can either roll over their sales gains into another DST or cash out entirely. 4. The DST sponsored has limited authority to make capital improvements, except for those associated with A. Normal repair and maintenance, B. Minor non-structural capital improvements, and C. Those required by law. This provision is intended to protect investors from ill-fated capital upgrades that could ultimately put the beneficiary's investment at risk. 5. Any cash reserves being held between distribution dates may only be reinvested in the DST's short-term debt obligations. DST sponsors must be proper stewards of investor funds. 6. All cash other than necessary reserves must be distributed to investors on a regular basis, intended to prevent this misappropriation of funds being held by sponsors. And 7. The DST sponsor cannot renegotiate existing leases or enter into new leases after the offering has closed. Lease terms can have a dramatic effect on the revenue and may impact an investor's returns. However, with a master lease, the DST would be able to lease a property to a master tenant, who may then enter into new or renegotiate existing leases with sublessors. This helps ensure that the sponsor won't make any risky leasing decisions. At Perch Wealth, we're here to help. Our team would be happy to answer any questions you may have about DSTs and help assist you with a 1031 exchange. Contact a dedicated representative today or visit perchwealth.com for more information. This video presentation is not an offer to buy or a solicitation to sell a security. The video is a discussion pertaining to one or more investment strategies and/or asset classes, and is not a discussion of any specific offering, past or present, of securities. As a reminder, there is no guarantee that any investment or strategy will perform as targeted, and any investment involves the risk of the loss of some or all principal invested. This video contains statements intended for educational and hypothetical purposes only, and is not to be construed as a promise of performance. Information presented herein reflects the opinions of the speakers and is from sources believed to be reliable, but all information is subject to change. Not an offer to buy, nor a solicitation to sell securities. Information herein is provided for information purposes only and should not be relied upon to make an investment decision. All investing involves risk of loss of some or all principal invested. Past performance is not indicative of future results. Speak to your finance and/or tax professional prior to investing. Securities offered through Emerson Equity LLC, member FINRA SIPC. Only available in states where Emerson Equity LLC is registered. Emerson Equity LLC is not affiliated with any other entities identified in this communication. There is no guarantee that any strategy will be successful or achieve investment objectives. Potential for property loss. All real estate investments have the potential to lose value during the life of the investments. Change of tax status. The income stream and depreciation schedule for any investment property may affect the property owner's income bracket and/or tax status. An unfavorable tax ruling may cancel deferral of capital gains and result in immediate tax liabilities. Potential for foreclosure. All financed real estate investments have potential for foreclosure. Illiquidity. Because 1031 exchanges are commonly offered through private placement offerings and are illiquid securities, there is no secondary market for these investments. Reduction or elimination of monthly cash flow distributions. Like any investment in real estate, if a property unexpectedly loses tenants or sustains substantial damage, there is potential for suspension of cash flow distributions. Impact of fees and expenses. Costs associated with the transaction may impact investors' return and may outweigh the tax benefits.